Hello, good morning to all. Welcome to a brand new week ahead. I'm Kelvin Wong here, the Senior Market Analyst of OANDA Asia Pacific. Welcome to today's Daily Dose of Market Insights. Today will be Monday, the 5th of February 2024. So before we start our Daily Dose, let's take a look at the disclaimer slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice for any recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so let us get started. A quick recap on what happened on last Friday, which is pretty much important. Why? Because it could have a ripple effect on the global markets in the next couple of days. So the key event that took shape on Friday was the US non-farm payroll data release. So US non-farm payroll data is actually the state of the health, the health of the US job market. Why is it important? Because the Fed will use the condition on the US job market to gauge their start of the anticipated first interest rate cut. All right, so on Friday, the US jobs number came in very hot, way above expectation. So it came in at above 200K jobs added in the month of January. So this was the results, the data released on last Friday. So what you could see over here is that the US economy added 350K jobs in January. All right, so it was actually way surpassed above the expectation. Markets are only expecting 180K, and as well as the previous month of December. Previously, it was around 200K jobs added, but after doing we call it final, we call it calculation, the department I would say the labor statistics, okay, the Bureau of Labor Statistics that's in charge of collating the official US non-farm payroll data, revised it upwards to 333K added. All right, so what we could see over here is that the US economy, if you look at the 5-year trend, you can see it quite clearly here because it's a blip here. So basically, whatever amount that you see on last Friday that was released, which is 353K for the month of January, it was close to more than a year of a highest monthly jobs being added on a per month basis. So what it implies to us that the US economy is not going south yet, despite the fact that we have 1.5 years of interest rate hiking cycle by the Fed. So with the job market still going on strong, yes, we start to see layoff in some of the mega cap technology, we call it firms like Meta, Google, or whatsoever. But however, the broader economy is still adding jobs. So it's very hard for the Fed to actually ignite their first interest rate cut in March. So still recall that last week was also an important week where we had the first FOMC meeting. So during the FOMC meeting, Powell has already pushed back the expectation of the first interest rate cut to come in March, because previously in December all the way up to early January, the expectation was close to 70 to 80% for the Fed to cut in March. So this has really been more or less killed off by this rosy non-farm payroll data that was released on last Friday. So what we could see over here is that, let me share with you, go all the way up to the, okay, 1 second, yeah, the current one, yeah, so that you guys could see much clearer. So let me expand my screen on a bigger scale. Yep, so go see it. So this was the next meeting in March. So basically, the first rate cut expectation has been killed off as being priced in by the Fed funds futures as calculated by the CME Fed Watch 2. So right now it's only saying 15% chance of a cut. So that's way below 70 to 80% that was priced in much earlier in the month of December and early January this year. So right now, what we could see is that the expectation for the first cut will be pushed back to May meeting instead. So the May meeting instead, pretty much still stabilized at 56.7% chance. All right, down slightly from Thursday prior to the non-farm payroll data. That was about 60% chance. But what we could see over here is that the total expectation of the amount of Fed cut that is being priced by the futures market has been reduced by one. So previously in December, the market participants, as inferred by the Fed Fund futures market, has priced in at 6 rate cuts in total for 2024. But right now, due to what happened last week, the amount has been reduced by 1 to 5. So how do we see it? Is just go to the probability tab, like what I'm showing here right now, and you look at it on the one that is in turquoise blue. So this is March over here, so there is no cut, nothing, so it's 15.5. So you count all the way down, 1, 2, 3, 4, 5. So right now we only have 5 interest rate cut that is being priced into the market. So with that scenario, right, we start to see a spike in the US 10-year Treasury yield, but still below the 4.06%. So what we could see over here is, let me share with you the market reaction from there. Okay, so the US 10-year Treasury yield spike up on Friday, but still remains below the 200-day moving average and the 4.06% that was taken out way earlier before FOMC meeting and last week, and the non-farm payroll data released on Friday. So you guys could see over here. So what it did so far over here is a retracement of the previous down move from last Thursday all the way down to from the high of 25th of Jan all the way down to last Thursday low. That means before the release of the non-farm payroll data, it retraced exactly 76.4% retracement. So what we could see over here, right, if it starts to see a bit of what I call bearish reaction today, because today is still starting, it's not the end of the day yet, we could potentially see another round of soft, we call it soft US 10-year Treasury yield going forward or sideways. So given the fact that it's still on resistance, so that actually explains the fact that in general, the US stock market still managed to rally on last Friday, despite even though the odds starts to tone down in the expectation of the Fed interest rate cut cycle for this year. So overall, the SPX managed to gain 1.07%, the Nasdaq 1.72%, which is the top performer. The Dow Jones Industrial Average 0.5%, and the worst performer was the Russell 2000, negative 0.59% due to its small cap and growth status, which is pretty much more dependent on that to run their operation. So if you look at, this is the heat map on the S&P 500 on last Friday. So what I could see over here is the gains are heavily being contributed by the mega cap 7 again, with the exception of Apple, because of that very weak lackluster guidance upon the release of their earnings on Thursday, due to also a weak sale on China as well. And it actually right now, last Friday, the Meta rallied the most I would say that in terms of a single day, I think the single day release is one of the most gain in terms of stocks historically, because they gain positive 20% in a single day. All right, that's pretty much amazing. Whatever some of us may debate that it could be a bubble in the making. Yep, possible. But from a technical analysis perspective, we are looking at trend. If the trend hasn't ended, the bubble could continue to inflate. All right, so later I'll touch more on the Nasdaq 100 short-term technical outlook. So all in all, right, what we could see over here is Amazon so positive, close to 8%. Nvidia as usual, AI optimism plus 5%, together with AVGO, another chip company that is benefiting from this AI bandwidth as well, plus 2%, as well as Microsoft 1.84%. So all in all, right, what we could see over here is that we could argue the fact that the 10-year US Treasury yield still remains below 200-day moving average, below 4.06%. That means, i.e., there is still no big scare of a big spike up in the 10-year US Treasury yield like we see earlier on in the period of this over here, previously in August to October. So if we recall that during August to October during the month of July, the late summer months of last year, from July all the way to August to early October, there's this big spike up in the 10-year US Treasury yield, which lead to a broad-based sell-off in the US benchmark stock market. So as long as it still remains below 200-day moving average, market participants from the stock market right now doesn't seems to be implying we may start to see this round of spike up again. For sure. So yeah, we're now monitoring the levels step by step from a technical perspective. So first level to watch will be the 4.6% and the 200-day moving average at 4.2%. All right. So as long as this level maintains being kept on a short-term basis, potentially we could still see a bit of positive feedback look back into the US benchmark stock market, perhaps for a lesser degree on the Russell 2000. But however, it doesn't gel well for the FX market. So if you look at the FX market over here, the dollar index actually surpassed the 200-day moving average again. Okay, it manages to surpass the 200-day moving average. So right now, right, it's intending to go into this next resistance zone at 104.30, 104.85, which was the 61.8 Fibo retracement of the previous medium-term downtrend from the high of 3rd of October all the way down to the low of 28th of December. So that's 61.8% now at 104.85. So what I could see over here, right, in a couple of days time, let me talk from a very short-term perspective, around 1 to 3 days, we could still see a bit of dollar strength movement back into the market. And once the dollar index hit this 104.85 region level, like that you see over here in my mouse over here, that could actually start to see the RSI back in the overbought zone, and we will monitor what's the price action like upon hitting this level. If we start to show a bearish reversal candlestick pattern on the daily basis, that means i.e. we could potentially see the start of a bearish reversal back again on the dollar. That means dollar weakness coming back into the picture. But we are now taking things one step at a time. So 1 to 3 days, potentially we could see a bit of dollar strength coming back into the FX market for some of the pairs we will highlight later. Then for WTI crude oil, so crude oil have a bad day on Friday for the on the bearish perspective. So WTI crude down negative 2%. So this is also due to the fact of a stronger dollar and also this ongoing potential ceasefire that's being negotiated by the Israel and the Hamas militants. All right. Then as for gold over here is the XAU fall by a lesser degree, is still holding above the 2025 short-term pivotal support level, only down negative 0.7%. So gold right now is being squeezed between two factors. On the upside is being resisted by dollar strength also, and on the downside is being supported by this still ongoing fluid Middle East, we call it situation, and the Red Sea shipping route, despite the fact that there's still tick for tat, we call it hostility between the stakeholders over there, that is still putting on a bit on the geopolitical risk premium that is benefiting gold on the that is providing support for gold. All right, despite a strong dollar strength that we see on last Friday. Okay, so that actually sums up for the joining the dots for the global markets perspective, taking into account of what happened on last Friday. So now let us now straight jump into the short-term technical outlook. We call it a chart that I'll share with you all. So let us start with the we call it the major benchmark stock indices first. All right. Okay, over here, let me share with you all. Okay, good. Then let me expand my screen so that you guys could see. So let us start with the US stock market first, right? So let us start with the strongest, which is the Nasdaq 100. So what we could see over here is that the Nasdaq 100 continue to churn upwards, higher high, almost hit the first resistance that we highlighted on Friday, 17, or in fact, not highlighted since the start of last week, 17,750, printed a high of 17,686 before it starts to shape that pullback, and right now it's trading kind of sideways during the Asia session. So what we do over here is that we will be having a much more we call it risk reward, a better perspective, is to tighten the short-term pivotal support level towards this minor congestion area over here. Previously was resistance, turns into a pullback support on Friday. So this sell-off, right, actually took shape during the release of the non-farm payroll data. Then thereafter, it managed to shape that recovery. Okay, so given that this is a kind of a minor V-shaped recovery, and also it occurs during a major risk event, which is a non-farm payroll data release. So for sure, if the boost were to remain positive going forward, it should hold above this Titan key short-term pivotal support level. So we'll be using this Titan key short-term pivotal support level for today, 17,360, to maintain our short-term bullish bias on the Nasdaq 100. Above 17,750, may see the next intermediate resistance coming in at 18,000/18,030, which is a Fibo extension level, and as well as confluence with the top of this minor ascending channel that I drew from the bottom of October 2023 low. Only an hourly close below 17,360 will negate this bullish tone. So on a short-term basis, we may start to see a choppy corrective minor decline down move to retest the lower boundary of the ascending channel at 17,060, which is also confluence pretty much closely to last Thursday minor swing low. All right, Dow Jones Industrial Average. Okay, so Dow Jones Industrial Average, the move was not as drastic as the so-called the Nasdaq 100, because the Dow Jones Industrial Average, which is the US Wall Street 30, doesn't have much significant weightage on the mega cap stock. All right, the mega cap tech stock as per se. So what we could see over here is that it hit the first resistance and start to shape that pullback. So I do not want to use this level here, which is the range, minor range support, turns into a pullback support level at 38,500. It would be too tight. So I will still maintain that 32,200 level as my key short-term pivotal support for today. Still maintain that bullish bias in any form of minor pullback above this 32,200/32,080. Next resistance to watch above 38,750 will be a Fibo extension cluster level at 38,950 slash 38,970. So if I'm not wrong, it's all confluence with this ongoing minor ascending channel resistance as well at this strike. Okay, sorry, this will be much, take it, yeah, over here, because it linked this high, yeah, this high. All right, so how also right now this minor ascending channel support also acting as a same confluence with the pivotal support I highlight 32,200/32,080. Only an hourly close below 32,080 will negate this bullish tone to see a minor corrective decline to test the 37,800 level, which was a former key minor range resistance, and now turns into a pullback support. So then that overall still maintain that bullish bias on the major US stock indices, the US Wall Street 30 and the Nasdaq 100. We do have much a tighter key short-term pivotal support for today to maintain each bullish bias. All right, now moving on to the German 30. So for the German 30, no change. Price action try to hit the previous minor swing high area of 17,200 level, and it starts to sell off upon the release of the data, the strong job data. Then thereafter, it just trade lower. Okay, so it's still maintaining that 16,795 short-term pivotal support level. So as long as this level still maintained, we will still maintain that bullish bias on the German 30. But however, it got to have a clearance above 1720, pardon me, 17,020, to give it a bit more impetus for the bullish tone to come back into the picture, for the next resistance to come in at 17,130/17,155. Only an hourly close below 16,795 will negate this bullish tone to kickstart another round of corrective decline, minor corrective decline within its still ongoing short and medium term uptrend phases that is still intact, to retest the 50-day moving average, now acting also as a graphical resistance at 16,620, and also the Fibo 61% Fibo extension, taking Fibo retracement, pardon me, taken from the previous minor uptrend of 18th of Jan low to 30th of Jan high, which confluence at the 61.8 Fibo retracement, which is at 16,620, confluencing graphically and as well as the mathematically upward sloping 50-day moving average, all pointing at 16,620. So net no change. As long as 16,795 short-term pivotal support holds, we will still maintain that short-term bullish outlook on the Germany 30. Japan 225. So Japan 225 going to be very bullish in terms of the trend. Going to shape higher high, higher low. So last Friday, in fact, today Asia session is try to test again at 36,540 before we sell off, and right now attempting to go back again. Okay, to test the 36,540 level that we highlighted on last Friday. And also, you look at the RSI going to be maintained by this upward sloping parallel support, and now shape a higher low right above the 50 level mark. Okay, so indicating to us that the upside momentum still remains intact on the Japan 225, at least in the short term. So no change, or we'll be using the 200-day moving average, not 200-day, pardon me, 20-day moving average, still acting as a support level for confluencing with the minor range support low of 31st that is in place since 26th of Jan at 35,745. So as long as 35,745 short-term pivotal support holds on a Nikkei 225 / Japan 225, we will still maintain that short-term bullish outlook on it. Breakout above 36,540 hourly close above it, potentially sees a retest on the previous minor swing high area of the swing high area of 23rd of Jan. We also correspond to the psychological level of 37K, and above it sees 37,480 Fibonacci extension level. And what's this light green line over here? If you go to the daily chart, it's the upper boundary of this major ascending channel that is in place since the low of 29th of December 2022. All right, so net no change as long as 35,745 short-term pivotal support holds on the Japan 225, still maintain that bullish outlook. Only an hourly close below 35,745 negate this bullish outlook to see another round of choppy minor corrective decline. We in is medium-term uptrend phase. Why medium-term uptrend phase is still intact? Because it's still holding above the upward sloping 50-day moving average. Next support level to watch with the break of 35,745. First step will be 35,350. The minor swing low area of 17th of Jan. All right. Now, the segment of Asia, Hang Seng. So Hang Seng continues to be choppy right now, but still managed to hit the first support level that we had on last Friday. Last Friday, we do have a bearish bias hit, and now attempt to do a pullback over here. So this push up itself, right, is actually being driven by on last Sunday, just right away yesterday, the regulator, that means the regulator that's in charge of the China stock market, the China Securities Regulatory Commission, he came up with a statement, make a pledge to actually votes to stabilize market after rout. Okay, but it did not offer us any detail. So that's as usual again, a bit of verbal intervention, but without any clear signs of what are they going to do next. So market could be a bit, there's still risk of another down leg on the China-related stock market. That means, i.e., it could have a negative feedback look back into the Hang Seng Index, which is the Hong Kong 33. So with that, I'm pretty much unconvinced that we will start to see the start of another we call round of more significant counter trend rally, unless we have a clear break of the 15,900 level, which is also the downward sloping 20-day moving average. So with that, right, we will still maintain the bearish outlook in any bounces as long as 15,900 short-term pivotal resistance is not surpassed to the upside. First support level to watch will be definitely today's intraday swing low. At the moment in time, will be at 15,255 level. All right, a break below 15,255 level exposes the psychological level of 15,000 next. Only an hourly close above 15,900 will negate this bearish tone to kickstart another round of minor counter trend rebound to test the minor range top of 24th of January to 29th of January, acting as a resistance at 16,220, also converging with the downward sloping 50-day moving average. All right, so all in all, the short-term downtrend still remains intact on the Hong Kong 33 index. All right, so overall, despite even though there's some verbal intervention on the on Sunday, but we do not see the price the short-term trend invalidate yet on the short-term downtrend being invalidated yet on the Hong Kong 33. All right, so that's sum up for the stock indices. So let us go to the FX market next. All right, so FX market, like I mentioned earlier on, that we could see a bit of dollar strength coming back into the picture. So let us start with the euro dollar first. So the euro dollar right now, right, it broke down below 1.0795 level, the short-term pivotal support that we have on Friday. And what we could see right now, right, is now potentially may hit the lower boundary of this minor ascending channel that I drew from the high of 11 Jan, also confluencing with the one-time Fibo extension of the previous down leg from the high of 28th of December, low of 5th of Jan, project it to the high of 11th of Jan, also confluencing at 1.0740. So with the fact that over here is that I don't want to use the 1.0795 as a short-term pivotal support, pivotal resistance level for today, to maintain that short-term bearish, to flip to a bearish buy, short-term bearish buys on the euro dollar. I rather use the 200-day moving average slightly higher at 1.0840. 1.0840, also confluencing with the 61.8% of the recent sell-off on last Friday. All right, so as long as any bounces over here, it may start to shape a bounce because of the oversold level on the hourly chart. So as long as this bounce didn't surpass 1.0840, potentially right around this area here, the euro dollar may see another down leg to test the support level at 1.0740. Okay, only an hourly close above 1.0840 invalidate this bearish tone on the euro dollar to see another push up to retest the minor range top of 1.0890. We also confluence with the downward sloping 20 and the 50-day moving average as well. So now the sterling dollar. So sterling dollar last Friday, right, it didn't break above the upside trigger level 1.2760 that we highlighted, and it starts to plummet all the way down over here, and now breaking below the support level that we highlight on last Friday as well at 126.10. So given the break of this 126.10, we'll be flipping to a short-term bearish bias in any bounces. So this bounce shouldn't surpass the 50-day moving average as well, now acting as a resistance at 126.70. So as long as any bounce didn't surpass 126.70, potentially further weakness could be seen on the sterling dollar, at least in the short-term basis, to test the next support level at 125.50, which is also confluence with the 50-day 200-day moving average as well. I think as a support, and this graphically is a congestion zone over here, slash 125 figure level, which is the minor swing low of 8th of December and 13th of December last year. Only an hourly close above 126.70 will invalidate this short-term bearish tone on the sterling dollar to see another round of choppy movement within a range configuration to potentially retest the upper limit of the range at 1.2760 again. Aussie dollar. So Aussie dollar pretty bad. So Aussie dollar right now, it broke below the 65.20 level. Okay, this is the medium-term support level. So potentially right now, it may churn down lower to 63.90 going forward. So with that, and then the daily RSI, there's no signs of a bullish reversal as well, shaping lower low and hasn't hit the, now inching towards the oversold region. All right. So indicating with us that there could be still some more potential weakness going forward on the Aussie dollar from a daily chart perspective. So on the shorter time frame perspective, right, this is where we tidy up the levels, the pivotal levels. All right, so with that, right, we'll be using any potential bounce, because now it's at the oversold region. All right, but oversold, there's no bullish divergence. It's showing lower at this point in time. Okay, lower, not higher low. So what we could see that is oversold, and right now it just exit from the oversold region. So, but given that it's no bullish divergence, there's low chance of a more significant short-term recovery. So in fact, it could be just a dead cat bounce. So the dead cat bounce over here could be around this region. Okay, so we'll be using 61.8 Fibo retracement of that last sell off on last Friday over here. We also correspond to the 200-day moving average. Okay, 65.70. So in any potential dead cat bounce that didn't surpass 65.70, pardon me, 65.70 short-term pivotal resistance level, potentially another leg of another, we call it a potential bearish short-term weakness could surface on the Aussie dollar to test the next support level at 64.50. All right, only an hourly close above 65.70 negates this or invalidates this bearish tone to see a squeeze up to retest the minor range resistance again at 66.20/66.50 level. All right, over here. Okay, so net flipping to a bearish bias on the Aussie dollar as well. Now, dollar yen. So what's interesting on the dollar yen over here is managed to squeeze up our Titan key short-term pivotal resistance that we have on 148 that we highlighted on last Thursday, and hit the minor range top again of 149.80. Yeah. Okay, sorry, not 149.80. What is this? Okay, 148.80. Okay, typo error. 148.80. Okay, 148.80. Tested one time, tested twice, tested three times again. And what happened over here is highlight to you is this, even though it made a higher high on last Friday, okay, a higher high, but if you look at the RSI, right, the RSI is sloping downwards, okay, and now it managed to exit the overbought region. So what it means that on Friday, yes, despite that squeeze up on the dollar yen, but this uptrend, the upside momentum on last Friday is losing strength via the appearance of the bearish divergence on the hourly RSI, and right now during the Asia session exit of its overbought level. So what we could do over here is that potentially there's some sign of dollar weakness coming back into the yen. So with that, and plus this is a what it occurred at a clear minor range top as well, clear graphical minor range top resistance at 148.80. So we'll be using 148.80 short-term pivotal resistance level on the dollar yen, still maintaining that short-term bearish outlook. First support to watch for sure will be at 147.85. That caused the further acceleration of the dollar yen. Okay, 147.85, also the upper limit of this strong hourly candle, and the pullback resistance now turned into a pullback support level, this light green line over here, also conversing at 147.85. Only an hour close below 147.85 will reinforce that further bearish tone to retest the minor swing low of 1st of Feb and 2nd of Feb, now acting as a support level at 146.25. All right, so still maintaining that short-term bearish outlook given the negative elements that is still prevalent that I share with you all in the dollar yen. Only an hourly close above 148.80 will invalidate this bearish tone to see a further squeeze up to test the medium-term range resistance at medium-term resistance zone at 15 pardon me, a bit of sore throat, 150.20/150.70. All right, now lastly will be oil. Spot gold. Let's go to spot gold very quickly. So spot gold over here, what you see in spot gold, this 2029 level will still be the short-term pivotal support level to watch for sure. As long as this level managed to survive for today, still maintain that bullish outlook. But however, the resistance, the near-term resistance only will be at 2060 level. This range top that is being formed on 5th of Jan, that hasn't surpassed it so far. Okay, only hourly close below 2029 negate this bullish tone to see a further minor corrective decline to retest the minor congestion area of 25th of Jan 2015. Below it exposes the psychological level and the medium-term pivotal support at 2000 level. All right. Lastly, West Texas Oil. So West Texas Oil, last Friday, we do have a neutrality. We flipped to sideways. So given the fact that last Friday it broke below the sideways range at 72.60, so now this will be a pullback resistance, 72.60. So I do not want to use 72.60 as my short-term pivotal resistance level because it's too tight. So I rather use 74.20 right now, which is confluence with the 20-day moving average acting as a resistance as well. And also, if we do the Fibo retracement, it's exactly the 38.2% Fibo retracement. All right. So in any case, right now there could be a rebound taking shape, but this rebound could be a potential dead cat bounce. So as long as it didn't break above 74.20 level over here, potentially it could see another further short-term weakness on West Texas Oil. towards the minor swing low area of 9 of Jan and 7 of Jan, acting as a minor support zone at 70.50/70.20. So flipping to a bearish bias as long as 74.20 short-term pivotal resistance holds for today on the West Texas Oil. Only an hourly close above 74.20. It validates this short-term bearish bias to see another round of choppy squeeze up to test the next resistance at 75.75. All right, so that's sum up for the outlook on the various cross assets classes. So now let's take a look at the economic calendar to look out for the key events to look out for today. Okay, so today should be a rather quiet day over here. So what we could see over here is, yeah, it's nothing pretty much key. Except we have the finalized Jan Eurozone PMI data, all right, for the services, and as well as the services finalized PMI data for US. But what's important over here is that market participant will be monitoring the ISM services. So US, there's this there's two institute. One is S&P MICIT, which compile all the global PMI. But for US, right, the market participants will tend to monitor the PMI data compiled locally by this Institute of Supply Management Institute in US. So as you know that US is 70 to 80%, close to 70 to 80% comprises of services activities. So the services PMI data will be closely monitored by the compiled by ISM, is out at 11 p.m. Singapore time. So market participant is expecting another round of recovery to 52, all right, level from 50.6 in December. Okay, so that's pretty much sum up for the key data to look out for today in terms of the economic calendar. So with that, do have a great day ahead, and we shall speak again tomorrow. Thank you.